Welcome back to another episode of Investies. I'm your host, Linda Garcia, and this week on the podcast, we are going to be discussing how the top 1% just hit a new wealth record. We're also going to get into new inflation data and how this is affecting the rest of us. Before we get into today's episode, I just want to give a special thank you to all those that have joined our Patreon. Your support of $3 a month helps us pay the bills, and myself and the team are grateful for that. If you want more information on the benefits that you receive when you join Patreon, please head over to patreon.com/investies. This week, we received important inflation data known as CPI. CPI stands for Consumer Price Index, and it measures the change in prices for goods and services paid over a period of time. It is used to measure inflation experienced by us as consumers. This inflation data signals to the Federal Reserve what steps they should take for monetary policy moving forward. Unfortunately, we have higher than expected inflation data. Every single month, there are analysts that are looking at the potential for higher inflation, lower inflation, or inflation that stays at the same rate. Our inflation this month came in higher than expected. There are two issues that I think are worth mentioning when you have inflation that is higher than expected. The first is the most obvious, which is that inflation is increasing. And the second is that it is increasing higher than our expectations, meaning that we do not have a clear understanding of how sticky this inflation is. When you hear the sophisticated term sticky inflation, no, I did not make that up. That is an actual term. This just means that the feds are having a harder time lowering inflation than they had originally anticipated. So the data shows that inflation increased month over month 0.4%, and year over year, the increase came in at 3.4%. We can expect a normal increase of inflation at 2% a year. However, inflation ever since 2021 has been increasingly high. Although inflation is lower now than it was in 2021, it's important for us to understand that the new numbers we receive each month do not mean that inflation is decreasing. We are still experiencing high inflation. The costs of goods and services have continued to increase since 2021. The difference is that the rate of increase has slowed down compared to the peak that we experienced of 9.1% increase in inflation back in 2022. For most Americans, our wages have not increased month over month. As a result, we must manage the increase in prices of goods and services with our current income. It's a problem. Unfortunately, the only tool that the Federal Reserve has in order to lower inflation is to increase interest rates or maintain them at the same rate that they are currently at. And this is crushing the middle class. Let's take a quick break, and when we get back, we are going to get into how the 1% has increased their wealth to a new record high. Investees, if you are enjoying this podcast week after week, if you find it beneficial, if you're learning from it, I ask you for a big favor. Please head over to Apple Podcasts and consider rating and reviewing the podcast. This really helps to amplify our work and shows the interest. We currently have so many of you listening to us weekly, but our reviews are not reflecting it. So I'm asking for a favor. Please, if you are enjoying this content, let me know by leaving a rating and a review. Thank you. And we're back. The Federal Reserve recently released data collected from Q1 of 2024, revealing that the wealth of the top 1% has reached a new record high of $44 trillion. This is known as the wealth effect. To put this type of growth into perspective, in 2020, the top 1%'s wealth was at $30 trillion. As you can see, the increase in 4 years was 14.6 trillion. That is a significant amount of growth in such a short period of time. If we look at 2015 to 2020, their growth at that time was only 5.6 trillion. And I think that the way they grew their wealth would shock most Americans. Not us here on Investies, because we do our homework when it comes to data. But most people will be surprised that it wasn't real estate and it wasn't their businesses. It was the stock market. The data from the Federal Reserve showed that while their houses increased in value, their businesses came down in value. So the increase of value in their houses and the decrease of value in their businesses was a complete wash. The growth, according to the Federal Reserve, as I already mentioned, was from the stock market. I have mentioned this before. There are 3 ways to build generational wealth in this country. One way is real estate. One way is being an entrepreneur and starting your own business, and another way is via the stock market. However, the stock market is not something that the majority of us invest in. The top 1%, however, they own 50% of the shares in the market. And according to this new data that was just released by the feds, the top 10% of Americans own 87% of individually held stocks. That number has decreased by a couple of points in the last year, which is great news as it means that more of us are participating in the ownership of individually held stocks. I believe that stock market participation has the ability to completely shift our mindset. It has the ability to change the way we look at money because we start to see the increases and decreases of money from a logical perspective, not an emotional one, immediately turning money into an actual tool that can generate more money. However, the majority of us are focused on making more money through our wages, and this is just not feasible. If we are only making money through our wages, this means that we are so much more susceptible to the impact of inflation. Contrary to popular belief, we do have the level of intelligence that is required to start participating in the stock market. We have the level of intelligence that is required to understand publicly traded companies and what it means to start participating as individual shareholders. We are not just consumers. The S&P 500 index has already increased 8.5% since the start of the year. And while I realize that investing in the stock market may seem like a privilege reserved for the wealthy, it's important for you to understand that even a small amount of money can yield significant returns. Regardless of how much you invest, the percentage of increase will be the same as it is for you, as it is for the wealthy. Not to mention that the increase in inflation is currently eating up at our wages. It is currently eating up at our savings account. A high yield savings account over the long period can't even compare to the return on investment in the S&P 500. This completely changes when you start to focus on investing in individual shares. This, of course, doesn't mean that you should start taking all of your money out of your savings account and start putting it all into the stock market. Absolutely not. It just means to take a part of the wages that you are making, begin the process of researching publicly traded companies, preferably the ones that you consume and understand from a consumer's perspective, and become part owner in the companies, not just own the products. I'm your host, Linda Garcia, and you're listening to Investees, a Cosmic Standard and In Lose We Trust production. A special thank you to the team, Eliza Smith, Jacob Winnick, and Asia Simpson.